If I give you a company's figures right now, can you confidently prepare both the income statement and the statement of financial position, the balance sheet, without mixing them up? Because this is where many ICAN, ACCA, and CPA students lose easy marks. Today, in the next few minutes, I'll show you the exact format examiners expect, step by step. No confusion. Stay with me. Let's look at the format for the income statement, which is called the Statement of Profit or Loss and Other Comprehensive Income under the International Financial Reporting Standards, IFRS. Okay, so if you have to prepare the income statement or the Statement of Profit or Loss and Other Comprehensive Income, as it's called, you begin with the company name. The company name is very, very important. In an exam situation, never forget about writing the company name. There is a mark or some marks allocated to this. Don't miss it. Now, after the company name, the next thing is for you to write statement of profit or loss, another comprehensive income for the year ended. You put the date. It has to be for the year ended, not as at. You have to write for the year ended. For example, for the year ended 31st December 2025. Good. Now, after that, you can go straight to revenue. Revenue is the first item on that format. So you put your revenue. The revenue is, it might be given to you on a platter of gold, or you may have to go and calculate it. But remember, your sales, selling price multiplied by the unit sold will give you the revenue. So the revenue is the first on the line. After the revenue, you have what we call the cost of sales. It is also the same as the cost of goods sold. If you don't call it cost of sales, you call it cost of goods sold. This is calculated by saying opening stock, add purchases, less closing stock. So opening stock, you add purchases, and you also add like carriage, the cost of carriage inwards, you add it. And then you say less closing stock, that is closing inventory. Stock is inventory, don't forget that. Closing, opening inventory, add purchases, add carriage, and you less closing inventory or stock if you're familiar, if you are used to calling stock. If you're used to inventory, stick to it, no problem. All of them are correct. And this is done in your workings, not on the body of the format. It is not a line item. The only line item there is cost of sales. That is all the examiner wants to see. After revenue, we say less cost of sales. But your cost of sales has to be worked by the side and you have to show your workings. Good. Now, after that, once you less the cost of sales, you will have what we call the gross profit. That is the gross profit. After the gross profit, what next? You have other income. If you have other income, you will add your other income to the gross profit. If there is no other income, you move ahead. Then you get to distribution costs. You will less distribution cost. Distribution cost is a deductible. It is to be removed. You less it. Also, you have administrative expenses. Administrative expenses is to be deducted. And then you go to other operating expenses. So your expenses, you say other income, you add, you remove distribution costs, you remove administrative expenses, and you also less other operating expenses. By the time you do all of this, you will have what we call operating profit. Now, from your operating profit, you come to finance income. Finance income is to be added to this total, this running total. You add finance income and you less finance costs. So you see it. Finance income will be added, finance cost will be less. So when you less finance costs, you will now get what we call profit before tax. Then your tax expense, which is calculated from your workings or as given to you by your tax consultant or tax accountant, you will bring the income tax expense and less it. When you less the income tax expense, then you will have what we call profit after tax. Good. Now, when you get to the profit after tax, you are not done yet. You move ahead to other comprehensive income. Now, other comprehensive income includes those items that are not in the profit or loss. They are not items that are your everyday activities, not in the main course of your business, like revaluation surplus. You can have revaluation surplus. For example, under IAS 16, you have the cost model and you have the revaluation model. So if you revalue an asset, the PPE, you revalue it, you can have a surplus. That can come in here. It is to be added. You have actuarial gain. If there is a gain, you add it. If there is a loss, you less it. Now, if there are fair value changes, you will also adjust this. Fair value changes will also come in here. Okay? Some will be added or deducted as the case may be, depending on the nature, whether it is adding to your profit or whether it is a reduction of your profit. So this adjustment will be done here. Good. Now, there are items that may be reclassified, like foreign currency reserve. They will be adjusted here. There's also cash flow hedge. This also will be adjusted here. When you do all of this, then you have what we call total other comprehensive income. When you get the total other comprehensive income, you will now add it to the profit. That's the profit after tax will be added to the total other comprehensive income. So when you add these two, profit after tax plus your total other comprehensive income, you will now get what we call total comprehensive income. So when you say that profit for the year is also called profit after tax. So profit for the year plus total other comprehensive income will give us what we call total comprehensive income. So you see total other comprehensive income, that is total OCI. Your total OCI plus the profit for the year. When you add them, you now have what we call total comprehensive income. At this point, we can say that you have satisfied the format for the statement of profit or loss and other comprehensive income, which is also called simply the income statement. Now, let's look at the format for the statement of financial position, that is the balance sheet. So we're going to look at the format for the balance sheet, or otherwise called the statement of financial position under the IFRS, International Financial Reporting Standard format. Good. Now, you begin with the company name. This is sacrosanct. Begin with the company name. After the company name, you now write statement of financial position as at 31st, you write your date. It might not be 31st, depending on the date of the company. The date that the company, that's the end of the period for that company. You write it. So usually, for this illustration, let's agree that is 31st December 2025. It means you write the company name and then you write statement of financial position as at 31st December 2025. I want you to note carefully. With the income statement, we say statement of profit or loss and OCI for the year ended, but for the balance sheet, for the statement of financial position, we don't say for the year ended, we say as at 31st December 2025. I will explain what that means after this format. So, the first thing to do is to begin with the assets. And usually we have to underline the assets and write them in capital letters, showing that it is a major heading. Under that major heading called assets, we now have a subheading which we call the non-current assets. Now, under the non-current assets, we have property, plant, and equipment. So you will bring in your property, plant, and equipment as a line item. In your workings, You will go and prepare all of it, do all the adjustments. You will do depreciation will be removed. You know, if there's revaluation, all of those adjustments will be done in your workings. When you finish the workings, you will now bring the line item: property, plant, and equipment. Property could be like furniture and fittings. Plant could be like, your plant, power plant. And then you could have the equipment, which is equipment, of course. So you bring all of this as a line item. After that, you go to another line item, which is intangible assets. Your intangible assets will come in here. Those assets that you cannot touch. You cannot touch. Those assets that are intangible, as the name implies, like your goodwill. But the goodwill that can come here is not inherent goodwill, but only purchased goodwill. So all your intangibles, copyright, you talk about trademark, you talk about so many other things that are intangible assets. They'll come in here. After that, you now go to what we call current assets. The current assets will come in here, like inventory. And of course, if there are any adjustments, they'll be adjusted in line with IAS 2 and brought in here. Then if you had trade receivables, you will bring your trade receivables after all the adjustments. Then you have cash and bank as a line item, all after adjustments. So by the time you total your current assets, you now add the current assets to your non-current assets, and you have the total assets. Next, we go to another heading, which we call the equity and liabilities. And we'll begin with another subheading, which is equity. Under equity, we have share capital and retained earnings, and of course, with all the reserves. So share capital will come in there, retained earning, which is brought from the comprehensive income. We'll bring it in. The total comprehensive income, if it is retained, we'll bring it in here and we add it. And of course, all the classes of reserves, any type of reserve will also come in here. They all belong to the shareholders. So that will give us a total of equity. Next, we'll go to non-current liabilities. Non-current liabilities. So we'll bring in all the items, the non-current liabilities, we'll bring them in. Okay, and then we'll have the current liabilities as a minor heading. So you bring in stuff like trade payables and then short-term borrowing. So you bring this in. At the end of the day, what do? You total your equity and the liabilities. So you have total equity and liabilities. So this total, the total of equity and liabilities, should be equal to your total assets if everything is correct. This is your check, and that is why we call it the balance sheet. Why does it have to balance? It has to balance because the accounting equation says assets is equal to equity plus liabilities. So if your asset is $10 million, then your equity and liabilities must be $10 million. So if you found this video useful, I want you to like, to share, and don't forget to subscribe to the Accounting and Finance Coach.